The Australian property market's been anything but predictable in recent years. Booms, corrections, interest rate hikes, and a housing supply crisis that's kept everyone on their toes. But what lies ahead? In today's episode of the Michael Yardney podcast, I'm thrilled to welcome back Dr Nicola Powell, Chief of Research and Economics at Domain, to unpack Domain's latest property price forecast report for the 2025-26 financial year. In other words, for the next 12 months. And this isn't just another forecast. We're going to be taking a deep dive into how affordability, population growth, government incentives, and even the psychology of homebuyers is going to shape our markets in the year ahead. So whether you're a seasoned investor, first home buyer, or just curious about what's going to happen to our housing markets, I believe today you're going to get some real insights into where property values are headed, which cities are poised to outperform because we're going to go through state by state, and how you can navigate or capitalise on what's ahead. From Sydney's record highs to the revival of Melbourne, from Brisbane's Olympic-fuelled momentum to Adelaide and Perth's cooling off, we're going to give you all the data. So let's get on with the show, and I look forward to you this week entering our property trivia quiz. After the main chat with Nicola, I'm going to once again have my weekly property trivia quiz where I give 3 copies of How to Grow a Multi-Million-Dollar Property Portfolio, my best-selling book, away to viewers or listeners of the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Nicola, welcome back. It seems every time we speak there's a new twist to our property markets, but reading Domain's latest house price forecast report for the financial year 25-26, I couldn't help the pendulum suddenly starting to swing back to the big East Coast capital markets, Nicola.
That was our core takeaway. So we do forecast twice a year, and this one is forecasting prices across our major capital cities for the next financial year. And I think, anything in the property market is really about trying to have an understanding of what we think is going to happen. And, I think there are going to be lots of shifts, but there are also going to be lots of opportunities. And it's all about navigating those over the next financial year. And pretty much to sum up what our forecast report showed is that we are expecting price growth across all of our major capital cities, both for houses and for units. But as you said, we are expecting stronger rates of growth to now be coming out of our East Coast cities. So that does mean it is Sydney, it is Melbourne, and we're predicting to have the strongest rates of price growth. And, that's a shadow compared to what we saw over the last few years, which really has been led by Perth, Adelaide and Brisbane.
Well, the cycle moves on, doesn't it? Now, we'll go into detail into your report, and I guess one of the interesting eye-catching clickbait titles or comments that you made, hope the media got attention to it, was that in general, Sydney's median house price may actually outpace the average wage of somebody living in Sydney. That's impressive, isn't it?
It absolutely is impressive. So the capital gains on a median house that we're expecting over the next financial year is $112,000. And the average pre-tax wage of a full-time employee is $103,000. This is a scenario where your home is going to be earning more than you are over the next financial year is what we're predicting. And I think when you see a stat like that, it tells you 2 things. You can understand why people want to own property. They want to own property in Sydney because Sydney does see big swings in price. And if you purchase at the right time and you're capturing that capital growth, this is it where it can be really changing financially for your wealth position. So you can understand when you see a figure like that, it's the whole headline where your home earns more than you. I think we probably all want to be in that scenario.
That would be a nice position to be in. Now, we're going to go in city by city in a moment, but let's start with the big picture, the macroeconomic themes that you used to put your report together, Nicola, because clearly our property markets don't work in isolation. So what did you and your team look at forecasting for this year?
So our property markets don't work in isolation, and there are some really core drivers that obviously drive demand for housing. And, it's the everyday things such as supply, what we think is going to happen to demand, things like the cash rate and what's going to happen, the outlook for the cash rate. But I think if I was going to pick out kind of four key things that really help to shape these forecasts or factors that we think are going to influence next year: lower borrowing capacity, really unlocking buyers and actually improving confidence, which I think we've started to see in some of our underperforming markets. We've also still got an entrenched housing shortage. This has not been resolved, and that undersupply of housing is still going to place pressure on price. And even when you look at population growth, when you look at the forecast of population growth over the coming financial years, it is expected to slow. But the big picture is we still have solid rates of population growth. It's just moving away from
Yes.
extreme conditions. And then you've also got accelerated first home buyer support. So there are four key things that we think are really going to shape next year.
Well, that first home buyer support will really kick in January next year when the new 5% deposit requirements are going to kick in. But you mentioned confidence, and I think that's an important factor with people now feeling that inflation's under control, that interest rates aren't going to catch them out, that they've got job security. Buyers seem more confident, and that's showing up on the regular domain reported auction clearance rates. More buyers are out there. That gives us a good in-time indication every weekend, doesn't it, Nicola, of what's happening on the ground. And once buyer confidence increases and prices go up, sellers then start to get confidence, and it takes time for them to put their properties on the market. So there is a cycle in how all that transpires as well. You suggested that this current financial year would be a transitional year. What do you mean by that?
I think it will be a transitional year. We've seen some really kind of extreme dynamics, I think, over the last 5 years of our housing markets. And I think what we're going to see this financial year is we are seeing improved borrowing capacity. So when you think of the 50 basis points reduction that we've already seen delivered from the RBA, that improves the average borrowing power by about $50,000. And when you look at that market pricing, the markets are pricing in up to collectively 125 to 150 basis point reduction. That's going to add over $100,000 to borrowing capacity. That is going to change dynamics. And I think it's going to be a bit transitional because we are seeing the growth scale tip from the West Coast and those mid-tier capital cities to the East Coast. We're actually going to be reverting back to what we would normally see in market dynamics. And you and I both know those big capital cities of Sydney and Melbourne tend to lead price cycles. And that really hasn't been the case over the last few years. And I think that the transition is going to be back to those focus on those major capital cities. But I think, if I go back to what I was talking about around borrowing capacity, one of the things that's really been holding price growth back is there has been this wide gap between where home prices are and the capacity for buyers to pay for a home. With the reduction in borrowing power, that's obviously going to improve, what a buyer can actually spend on a home. But overall, there is still this wide gap. And I think that in itself is going to slow down the pace of price growth. Like we haven't forecast, boom time scenarios. This isn't double-digit growth that we're forecasting for next financial year. I think what we're going to see is moderate growth because I think ultimately the core of it, budgets are still very stretched, particularly in our high-priced markets.
Well, it's also going to be more sustainable because significant property booms lead to downturns or longer flat periods. So I'm comfortable, and I actually, having read your report in detail, and I'll leave a link in the show notes, I'm very impressed with your forecasts, and I think they're quite spot on. So let's go through them state by state. Now, you suggested the East Coast capitals would lead the market over the next year when we know that Perth and Adelaide and Brisbane were the leading housing markets in previous years. But your comment was that in the past, drops in interest rate pushed up those big capital cities more than other places.
That is correct, Michael. So what you tend to find is Sydney and Melbourne are much more sensitive to changes in interest rates and changes to economic conditions. And what we're expecting is the reduction in the cash rate is going to be amplified through Sydney and Melbourne's housing markets much quicker than our other capital cities. And it's generally because of their size, the debt levels, the income profiles. It all means that a small shift in borrowing power can have a big impact. So So, how I would describe it is what we're seeing is the baton is definitely passing from affordability driven markets to interest rate sensitive ones. And that really highlights that transitional market that we were describing earlier on in this chat. So, I think our big call out is that Sydney and Melbourne are going to be much more responsive to the reduction in the cash rate. And I think we're going to see them lead price growth. And we're talking about clearance rates. Melbourne's been that case in point recently where those clearance rates are consistently hitting in those high 60s. That in itself tells me that we're seeing confidence in buyers coming back, and we're
On
seeing
reasonable auction volumes too. Sorry to interrupt, Nicola, but lots of more auctions than 12 months ago. Other than those holiday weekends, boy, we seem to have a lot of those over the last couple of months. But the buyers are out there. There's depth in the market.
Absolutely. And that's what's showing out in those clearance rates. I think, when you compare it to this time last year, it is poles apart, I think, from the Melbourne property market. And look, there's an element with Melbourne, and I did a market update recently, providing a bit of a sneak peek to some of our clients on the forecast report. And I gave Melbourne its own slide because I felt that Melbourne is going to be a key story to watch over the next financial year. Value, it's an undervalued market relative to other major capital cities. And our expectations is that Melbourne is going to see a massive turnaround compared to what it had seen. You will love these stats, Michael. Back in 2019, when you look at house prices in Melbourne and compare them to Perth, Adelaide and Brisbane, Melbourne was between 35 to 45% more expensive.
Yes.
Today, they're pretty much on par. There's about a 1 to 3% variance. So it's gone from 35 to 45% pretty much to on par. That tells us that the value is there in Melbourne. But what I would say is the value doesn't last very long, because when you see buyers come back, they see that value, and that's where you see momentum really start to come back into housing markets.
Your forecast for Melbourne was a price rise of 6% over the coming financial year, the next 12 months for houses in Melbourne, and 5% for units for apartments. Even at those levels, apartments are going to be still priced below replacement cost because new apartments just can't be pulled out of the ground with the cranes and the unions and the extra costs to become brought out and sold anywhere near those sort of prices.
Absolutely. There is such a wide gap between established pricing and new developments. And then when you compare, that 6% forecast for house prices in Melbourne versus what our expectations are for the financial year that we're currently in to end, house prices we're expecting to make no gain over this current financial year. And unit prices, where our expectation once we get to the end of this financial year are down by 3% for unit prices. So, to reiterate, it was a 6% and a 5% increase for unit prices. You can see that shift. That shift is it's starting to turn already. You're seeing that in the clearance rate, the buyer depth, as you mentioned. So, I think it is going to be a market to watch.
Okay, Sydney is going to perform just a little bit better. Your forecast suggested house prices would get a gain of 7%, taking the median house price in Sydney to $1.83 million. And then apartments are going to rise about 6% in Sydney. So Sydney will be the outstanding performer in the coming financial year.
That is our expectation. So is definitely the standout performer for house prices, up 7%. And along with Perth, at the 6% increase we've got forecast for unit prices, the two best markets also. I think, it's an interesting one because we do have a very high-priced market. And I think, when you look at that median house price that we're forecasting at $1.83 million, I think the conversation is really starting to morph into when is Sydney going to become a $2 million housing market, because we're not that far off.
Well, some people are asking, how can house prices keep rising so much when house prices have outpaced wages growth? But the fact is that a lot of people who own properties in Sydney have got substantial equity in them. So they are using them to upsize, to downsize, to right size, or using some of the equity to help their children into the market as well. So not everybody borrows to their maximum capacity, and not everyone buys a median house price in Sydney. It is unfortunately in some ways a story of the haves and have-nots. Those who've been in the market for a long time have paid down their mortgages and have got equity to allow them to do other things.
That's absolutely right, Michael. And I think, there were as headlines, in recent months in the AFR that, Sydney's going to have no grandchildren. And that is one of the core issues with Sydney is a high-priced market. And those that don't have financial support of family members to buy their first home, we do have young couples, young families leaving the city. They're moving into regional locations. They're looking for more affordable homes. But this is where, you've got the transport-orientated developments, you've got increased density, you've got governments really focused on supply. Unit prices we're forecasting to be just under $190,000. And I think realistically, if you don't have financial support, ultimately, I think many first home buyers are opting for units as their first home. And then, as you said, earlier on in our discussion around new incentives for first home buyers, our expectations as well is we're probably going to see some of those affordable pockets really perform well in Sydney, and particularly.
I think so. I'm going to annoy somebody, but first home buyers shouldn't expect to be able to buy a median priced house for their first property. There's lots of good accommodation, and there's still quite some good apartments in Sydney at very realistic prices, somewhere to start in the market.
Absolutely. And I think, probably Sydney was the one that really created that rent-vesta as well, where you rent in a city suburb, which is close to your work or your lifestyle in which you want to lead. And then you purchase in one of those, growing outer suburbs to gain that affordability, to get your first home and get a foot onto the ladder. And, I think lots of first home buyers, particularly in Sydney, are using that strategy to help them build up that equity, build up that capital growth to get into, to purchasing, the home that they want to eventually live in.
Well, Brisbane's been one of the strong performers, and it's got that tailwind of the Olympic Games with a lot of interstate migrants moving to southeast Queensland, with a lot of infrastructure being built, with still an affordability advantage. But you see that the Brisbane market's going to still grow well at 5% for both houses and apartments, but maybe not as strong as Melbourne and Sydney.
Yeah, and that's exactly right. I mean, Brisbane has got an awful lot going for it, and it's got an awful lot of infrastructure investment, and there is still a chronic undersupply of housing across the Brisbane housing market. We're expecting prices to rise, but not as fast as they had been, and we're still predicting, obviously, record prices because of that growth by the end of the financial year. One of the interesting dynamics from Brisbane, if you look at the change in household size over the past 5 years, Brisbane has seen the biggest increase out of all of our major capital cities.
Really?
Yeah, and I think that says a lot about the change in affordability. It means that we're people are doubling up, they're delaying moving out, they're living in multi-generational households. And you see that come out when you do see an extreme change in affordability, and that's what Brisbane has been. So I think actually the structural undersupply of housing is not going away, not in Brisbane. It's being masked a little bit at the moment by bigger households and delayed life stages because of that increase in household size.
Okay, Perth's been the star performer for a number of years now. After a long period of languishing, is it now starting to show some signs of moderation, Nicola?
I would pick Perth as probably the one that really is seeing the most dramatic slowdown. This is a market that provided homeowners and investors double-digit annual growth consistently over the last few years. It really was Perth in its heyday, really, reminiscent of those kind of mining boom times.
Yes.
But we are expecting growth to slow. We're expecting 5% increase for house prices, which means the house price in Perth is just going to be about $20,000 shy of $1 million. And our forecast for unit prices is 6%. So the interesting part here, Michael, is that we have got a forecast growth higher for units than houses in Perth, and it's the only capital city where we forecasted that.
Interesting. And why is that? Affordability?
Affordability and probably still that investor interest. I do still think that we've got, that bit of investors looking towards WA, the price point as well. The unit price in Perth is expected to reach just over $550,000 by the end of next financial year. So I think it's a little bit of both. I think it's the change in affordability has been very dramatic in Perth, but also probably investors, because yields potential is there when you look at Perth.
Now, Adelaide performed really well over the last few years, but its affordability advantage seems seems to be almost gone now that its prices have crept up so much.
It absolutely has. When you look at the new mortgage repayments as a share of dual income, we have seen a vast change. So 5 years ago was 27% of your income was needed to cover mortgage repayments. Today it sits at 55%. So a massive change. This has been almost the unstoppable market. It was, and which is really unusual for Adelaide. You know, Adelaide tends to be the quiet achiever, but that has not been the case over recent years. But again, we're expecting much more modest paces of growth. 4% increase for houses and a 3% forecast growth for unit prices. But that does mean we've still got two record highs for house and unit prices by the end of next financial year.
And Canberra, our capital, our country capital, that remains the most affordable capital, and it hasn't really performed very well over the last couple of years, has it?
So it is the most affordable capital in Australia based on home price to income ratio. We have seen this market really struggle to move into a recovery, but one of our core call-outs for the next financial year is both Melbourne and Canberra are going to move into an established recovery. We're forecasting a 4% increase for house prices and a 3% increase for unit prices, but that doesn't mean a full recovery for Canberra house prices. We're expecting them to be slightly below still their record highs. I think for house prices, we're forecasting them to be about 7% below their record high. But this is a marked change. I think we're seeing momentum start to build. It's not as clear as what we're seeing in the Melbourne housing market, but I would say we are expecting growth to unravel in Canberra, which is not what we've seen over the last few years.
Well, we've spoken a lot now about house price and unit price growth, but a third of Australians are renting, and some of those are renting because they choose to, others are doing it because just the stage of their life they're in and they want to get into the housing market. How do you see things playing out in our rental markets over the next year or so?
Yeah, the rental market we know has been very strained, and we technically still have a landlord's market across every single capital city. But I think our expectations are certainly for slower rates of rental growth. Those yields, those vacancy rates are starting to improve. We've seen investors come back in, and obviously we've got new first home buyer incentives, which are going to help some tenants transition to being homeowners. So what I would probably expect for the rental market is, I think we're likely to see some pockets of rents still rise, but I think we're expecting the next financial year to see slower rates of growth relative to the current financial year.
Yeah, first home owners were in the news a lot leading up to the election. It's gone a little bit quiet at the moment, but I can see the new first home buyer support expanding later or early next year with scrapping of LMI, with shared equity schemes, with getting in with a 5% deposit. While that's going to help some first home owners who've got the affordability to be able to service the debts, in my mind it's just going to inflate prices further and kick the can down the road on the affordability issue.
Absolutely. When you do a demand side policy, it's like giving a whole bunch of people a credit card, and it brings forward a whole lot of demand. And you and I both know if you increase demand and you've got first home buyers competing for similar priced properties and you don't increase the supply at that price point, it is going to inflate price. And while I am supportive personally of the right first home buyer incentives, we need to make sure that we don't create incentives that just make it harder for the next wave of first home buyers that come behind them. And I think, when you look at the supply pipeline, we are still not on track to meet the housing accord and pretty much across our states and territories. So, when you look at home construction, it's been in the shadow of population growth. So I'm expecting prices at that affordable price point to be inflated. Are you expecting the same?
I can't see the government being able to, the government was never going to deliver all those homes. They had this budget of, this goal, I should say, of 1.2 million homes by the middle of 2029. Unfortunately, there's labour shortages, slow approval pipelines, not enough materials, but it's really the cost that's a big issue. I recently spoke on this podcast to Tim Reardon, the chief economist of the HIA, who shared their figures that more than 50% of the cost of a new home in Sydney is taxes, local council taxes, including development levies, state taxes, including stamp duty, government taxes, including GST. So it's just very, very expensive to deliver the cheapest form of accommodation, which is plonking a single-storey home on a block of land out in the sticks, to deliver high-rise or medium-density apartments that the government's wanting developers to deliver, is just unaffordable at the moment. The finances don't stack up, the end values aren't high enough, and so developers are just not going to deliver it until established home prices rise enough to make new home developments more feasible.
And we see it even through our listings. When you look at the average price of a new listing, of a brand new apartment or house versus the established price, there is a wide gap. It is starting to narrow because we've obviously got a bit of price growth in the established market, but it is still large. And if you think we've got affordability constraints impacting buyers, they're going to buy established because it is lower priced. And I think until we see that parity between established and new, it's not going to tilt the demand back to new stock. And this is where I think if we had policies that really supported demand towards the new build, this is where you've got the double win, where you're supporting perhaps first home buyers, but it's also supporting the supply pipeline. I think that's where you have kind of a smart interaction of policy.
Yeah, I like your forecasts. I think they sound very realistic and very accurate. The other thing I know is there's every year an X factor, and not like the music TV show, but a black swan event that comes out of the blue to confuse us, confound us, whether it's global shocks, geopolitical problems, domestic policy changes. The government's talking about changing various taxes. Are there any black swan events or other factors like that you considered or you're worried about?
It's probably around the cash rate, to be quite honest. I think with what is occurring globally at the moment, there is a lot of instability around the world.
Yes.
And I think if we see, the things like supply pipelines being interrupted, oil, petrol prices increasing, that could have an impact on inflation. And ultimately, domestically, the core outcome for that means the cash rate could stay higher for longer. And we don't see as many rate cuts being delivered. I think that is probably where my core concern comes from when looking at where we forecast prices to go.
Well, earlier this year, there were talks about recessions in various countries. It looked like inflation was under control. Now with the geopolitical problems, it looks like maybe inflation will creep up again if oil prices go up. We're living in interesting times, Nicola. I think that was a curse, a Chinese curse that said, I hope you live in interesting times. It wasn't meant as a good sign. Nicola, as always, you've delivered a masterclass in market insight. What stands out for me is the market is turning, but not in the uniform way. And so with interest rate cuts, that may nudge prices higher. But as you say, affordability, supply pipelines and demand patterns are going to be the key differentiators. So not every market's going to do the same, but it never has been that way, other than that amazing boom that we had in 2020 when interest rates dropped to almost zero after COVID. But that was unusual. I see this as a more sustainable price rise, and I think it's a good time to make informed decisions, and reports like Domain's report, in my mind, is essential reading for anyone who wants to stay ahead of the curve. So I'm going to leave a link in the show notes for that. So thanks for giving our listeners and viewers a front row seat into what's going to shape our housing markets for the year to come.
Thanks so much, Michael. It's always a pleasure to have a chat.
Speak to you again soon. By now you probably know that each week I'm running a property trivia quiz. What I'm going to do is ask you a question, and if you know the answer, go to propertytrivia.com.au, leave your answer, and each week 3 people will win a hard copy of one of my best-selling books. At the moment, it's How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. And even if you got the answer wrong, everyone who enters is going to get a copy of an updated report that I just updated a couple of days ago. So this week's question is, which was the famous investor who is known for his quote, buy land, they're not making any more? Quick, I guess a little bit of a hint. It wasn't an Australian. It was a famous American investor who said, buy land, they're not making any more. Now, go to propertytrivia.com.au, leave us your answer. If it's correct, you'll be in the draw to get a copy of one of my best-selling books. If you don't get it right, because you've taken the trouble to leave an answer, you'll get a copy of an updated report. And I'm updating these regularly so that there's going to be the opportunity to get a different one each time you enter. propertytrivia.com.au. And don't worry if you're listening to an older episode, your entry will still count. In a moment, I'm going to share my popular mindset message. I've actually got a great message for you this week. But before I do, I want to just go back on what we heard when my conversation with Dr. Nicola Powell. And I hope that's given you confidence to understand that our housing markets in general are going to do very well over the next year. But you've got to dig down even better to get good rates of return. Most property investors, most homeowners are only going to realise this once the market is already turned, and they're going to be a little bit too late to capitalise on the changes we're now noticing. We talked about this before, that there's a narrow window of opportunity with interest rates expected to fall further, population growth still surging, government grants and incentives kicking in early next year. And as we said with my chat with Nicola Powell, rising auction clearance rates and increasing consumer confidence. But the fact is the smart marketers' money has already moved into the market. That's what's pushing the market up. So what about you? Are you clear on how you're going to take advantage of these opportunities, or are you still waiting? So I'm going to recommend you have a complimentary wealth discovery chat with one of our team at Metropole. We're going to have a one-on-one chat with you. We will clarify your goals. We've got no properties for sale. We're much more than another buyer's agent. What we do is help our clients safely grow, protect and pass on their wealth by giving you strategic advice and helping you understand how these macro trends we're talking about are going to affect your position. And with your permission, we'll help you build a personalised, data-driven property strategy so you can get ahead of the curve before the majority of others do. Go to metropole.com.au and have your one-on-one chat with the team at Metropole.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to talk to you about a mindset that could shape your entire life. Now, it sounds almost melodramatic if I say, do you want to know the secret to success? Not the kind that sells in 30-second sound bites or flashy headlines, but I mean the real gritty behind-the-scenes truth that separates those who consistently win, whether it's in business, investing, parenting, sport or life, from those who don't. Because here's the thing, over my decades in business, in property and personal development, I've observed a common thread amongst those who succeed, not just once or twice, but again and again. So whether they're super successful property investors, business people, or everyday Australians, they all seem to share one invisible but incredibly powerful trait, and they've learned to operate with an internal locus of control. Now, let me explain what this means. Way back in 1954, psychologist Julian Rotter coined the term locus of control, and it might just be the most underrated mindset filter that you probably never consciously thought about. Those with an external locus of control believe that life happens to them. They think the outcomes are a result of luck, of fate, the economy, the government, or what other people did. But those with an internal locus of control believe that they make life happen. They accept that while they can't control everything, they can control their actions, their reactions, their mindset, their decisions and energy. Here's the kicker. It's not just a theory. People with an internal locus of control tend to be more successful, mentally resilient and fulfilled. They experience less stress, bounce back faster from setbacks. They get more done because they believe they can, and belief drives behaviour. Look, you've heard me say it before, become the pilot of your life, not just the passenger going for a ride. When life gets messy, this sort of mindset matters most. It's easy to feel in control when the sun's shining and when the road is smooth. But when life throws curveballs, when interest rates rise, when deals fall apart, when tenants do a runner, or your kids get sick, I guess it's tempting to slip back into external thinking. It's not fair. Oh, this always happens to me. I can't do anything about it. But that mindset gives away your power. If you want to succeed, not just survive, you need to recenter yourself with better questions. What's within my control right now? What's one small positive action I can take? How would my future self handle this if I was more successful? What would I say to a friend who is in this situation? That's a good question. So I want you to take back the wheel, even if the road's bumpy. Remember, you're in the driver's seat, not the passenger seat. Now, this matters in property, in wealth, in life. So I've often said building wealth through property isn't a get-rich-quick scheme. It's about long-term thinking, resilience, and the ability to take personal responsibility, especially when things get hard. Markets change, politicians make silly decisions, the media run scare campaigns, but those things, they're outside of your control. What's inside your control is how you react, whether you panic or pivot, whether you freeze or act with clarity, whether you blame the economy or learn, adapt and grow. You don't need perfect timing. You need personal ownership. So my mindset message for you, I guess, is an uncomfortable truth. No one's coming to save you. But here's the empowering message in my mindset message today. You don't need them to. You're capable. You're resourceful. You're in control of your thoughts, your actions, your path. Don't wait for permission. Don't look for somebody to rescue you. Don't outsource your future. Take the wheel, own the journey, and keep going. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?